How much Bitcoin will the Bitcoin treasury companies eat up?
When I think about who's going to be the big bidder, like where's the capital going to come from for the next 20 years of Bitcoin's monetization, right? Like in the context of that global asset landscape chart that people know of from me, Bitcoin's tiny, equities and bonds are big, and money is also big. And that's a new thing that strategy is tapping into. But those three buckets, those are huge buckets. And everybody feels and knows that for tiny little thimble Bitcoin to grow, it's going to take capital from these other big buckets. But how? Like to date, it has been individuals waking up and saying, you know what, I don't want to hold all those bonds in my portfolio. I want to buy Bitcoin. And like individuals manually going through that series of steps we outlined to make that happen. And I think going forward, what happens is that Bitcoin treasury companies accelerate that osmotic flow of capital from these overvalued buckets to the undervalued Bitcoin bucket. They facilitate the flow of capital from each of these buckets by creating these products that meet that capital where it's at. And then when you think about how that's going to play out, who's going to be the bidder for Bitcoin when each Bitcoin's $5 million? Like the big bidder, I think, is going to be strategy because they just got the next $1 trillion of capital out of the bond market by offering them 10%. So that's how that bond market capital is going to flow into Bitcoin. It's not going to go directly to Bitcoin. It goes through strategy or the other winners in each capital market and then into Bitcoin. And so when you think about that context and like the big zoomed out view of like how big will that little bucket grow to be, that's why Saylor likes to use that chart because it frames it nicely of this is the best store of value asset in human history. How much value in the world is just looking for the best store of value asset? And Saylor has said it's 50%. It's a guess, something like that. It's 50%. And he thinks that capital will continue to flow into Bitcoin until it reaches, until it saturates pure store of value capital, which was up to 50% of all asset value in the world. But you're going to have these massive buckets deflating relative to Bitcoin as Bitcoin massively inflates over the next several decades. And the conduits by which that happens will be Bitcoin treasury companies facilitating that flow of capital. And for that reason, I think that it's quite possible, long explanation to get to this, of I think that it's quite possible that Bitcoin treasury companies accumulate half of all Bitcoin during this period. And 20 years from now, using Saylor's numbers of $13 million per coin in 20 years, that would make Bitcoin treasury companies, that would mean that they would hold $140 trillion of Bitcoin. And I think like strategy will end up owning half of that. So $70 trillion of Bitcoin, which would make strategy the most valuable company in the history of the world by a very large margin. And I think that the rest of that, that the remaining $70 trillion dollars of Bitcoin held in Bitcoin treasury companies is going to be the big story in global finance for the next 20 years.
Wow. What this connects the dots for me on is, I've been wondering all along, and I'll take my tinfoil hat off here because I think there's a real reasonable explanation, is that why is the United States government allowing MicroStrategy to accumulate all this Bitcoin, and why are they nudging them forward? And the conclusion I have come to is that they're not interested in buying Bitcoin, the United States government. They're not interested in buying an asset they can never sell because they would crash that market. They're not interested in marking up their gold and selling it. They're just, they don't need another buy and hold asset. They need to sell the debt. That's why they want the reserves on Treasury so they can sell the Treasury and capitalize on those flows. They need the Bitcoin market to go up so they could sell more Treasuries to the stablecoin companies. And so they need strategy to buy Bitcoin at 5 million per coin. And they need strategy to be the refinery. And they need all these companies to refine the Bitcoin into these markets so they can continue selling treasuries. It kind of answers that question for me. What do you think is also a big part of the next wave here? Is part of the end game perpetual preferred debt issuance?
It's just a natural evolution, really. It's a weird, scary idea. What does this mean? but it's just a really clever way to repackage typical debt issuance. Strategy was doing convertible note issuance, and that takes time. It takes months to set up your next convertible note. It's an event. It's an instrument, and there's lots of paperwork, prospectus. You have to go roadshow it to potential investors, gauge their interest, get soft commits, finalize the documents, announce it, launch it, collect hard commits, and then go collect the money for that, and then issue those securities. And that's a big process. And it takes months, and you don't get to decide overnight that conditions are right for you to issue more debt. Several months of lead time. And then they're not easily tradable. There's a lot of friction for the issuer and for the investor. And I think also a big part of it is like there aren't many protections for the issuer for strategy. In a typical debt arrangement, the debt holder holds a ton of power baked into those debt covenants that you agree to in the contract. And they can hold that over the issuer and cause problems. So I think that strategy quickly learned that this is a pain in the ass to do it this way. And it'd be a lot easier if we could sell at the market the way that we're doing with our common stock with MSTR. If we could just sell it at the market like a new little slice of convertible debt, that would be amazing. And this is how you do that. You bundle it into a preferred equity vehicle that the ownership rights of that share amount to the same benefits as convertible debt in the case of Strike, which is the first one they launched. And then Strife is just ordinary debt. Stride is a more junior ordinary debt. And now Stretch it's a money market fund instrument that is itself packaged up into a preferred equity instrument. So these are just easier ways to issue more debt, more money market promises, or convertible debt or ordinary debt in a way that you can do it the day that market conditions make it most attractive to do. And you can, as the issuer, set up the rights that you think are best rather than having to follow debt covenant norms. And you can structure where it is in where these instruments fall in terms of seniority in the capital stack. So it's just a way better way to do this stuff. And Saylor really pioneered it with lots of help from AI, which was a funny little anecdote he shared in Orlando, that these preferred equities are the first securities designed by AI because he was just hammering ChatGPT to figure out how you could possibly do it when his securities lawyers were like, I don't know if this is possible. But then with AI, he was able to get it 80% of the way there, something like that. And then the lawyers can figure out the details to make it possible.
Sure. Do you think, because it seems like Sailor's going further and further out on the risk curve to appeal to different buyers. And one part of the risk curve obviously would be stablecoins at perceived 0% risk in the fiat world because they're linked to treasuries and things like that. Do you think a company like Strategy will ever issue something like a stablecoin and or a partnership with a Tether or Circle to, if they can't because stablecoins aren't backed by Bitcoin in America right now? Do you see stablecoins as part of this curve or this evolution being paired with Bitcoin treasury companies?
Yeah, I haven't thought about that. It seems entirely possible, in fact, preferable to what do you want backing your dollar? I'd like it to be a highly over collateralized Bitcoin balance sheet. That'd be great. It does introduce what are the reasons why Tether is attractive to holders. And part of the reason is that it's like that they sit outside of the US regulatory environment and are a little bit defiant of US regulators. And that's actually attractive if you're someone holding Tether in a developing world and you don't want it confiscated by the SEC at any point. A Tether is probably a better thing to hold as opposed to an SEC compliant vehicle. That there's also that side of things too. But yeah, there's nothing stopping. I think this is why Saylor likes to use my chart of the global asset landscape is because it visually gives you a map of here's where all the value is in the world in analog assets. And Bitcoin's going to demonetize to some extent every single one of these buckets. Some buckets more than others. Like the bond market is probably going to get massively demonetized. Real estate, maybe less, but still. And so it's a map that he's showing everybody here's where all the value sits, and I'm going to go meet it with instruments designed to appeal to the value parked in each of these buckets, designed to offer what that capital is looking for in that bucket, but more. Right. So, like with bonds, like rather than 10-year Treasury bill getting 4.5%, Saylor's saying, I'll give you 8 to 10%. He's going to win market share because of that. And he's going to do the same thing in the money market now with Stretch. And he could design stuff. I don't know what this looks like, but maybe he'll design something to appeal to real estate investors or certainly other slices of the bond market and money market and the equities market probably are on the table for what he could construct using new preferred equities. And yeah, he's shaping the new yield curve by rebuilding what the traditional yield curve looks like. And there's still a lot of spots to fill in there. And I guess he's just going to keep doing it so long as there's new markets that are not currently being met by Bitcoin backed products, because backing your product with Bitcoin makes it so that you can pay more than anybody else, with a fiat backed product in all of these categories. So he's just going to keep doing that. And that's why he's going to he's going to pump a huge portion of the world's capital through his business into Bitcoin and then hold that Bitcoin on the balance sheet.
Yeah, it's interesting. If you think about every company is mining fiat, but if a Bitcoin company is mining fiat and they put an engineer in charge of the mining and he builds a much better engine to refine the Bitcoin into the fiat market. And I think of your chart as like a map of value in cyberspace or digital value in cyberspace. And all money is really digital at this point. It's just in different buckets. But you think about the map being a map of cyberspace because Bitcoin's the black hole.
Yes.
And it's just pulling in all this other monetization that you see in these other buckets.
Yeah. I like how you frame that. It's like a step change improvement in how do you generate value for shareholders. It's like going from whale oil to electric lamps. Let's let the engineer figure out what can we do with digital capital to benefit shareholders the most, rather than just like adhering to this tried and true model of let's just generate operating profits every year into the future. And that's how we'll do it. And this engineer has said, okay, I think the most undervalued thing in the world is digital capital. And I'm going to figure out how to get people to give me money so that I can buy more digital capital. That's as simple as it is. And that's the playbook he's pioneered. And there's nothing stopping that from happening everywhere in the world until Bitcoin has fully monetized to whatever its end state is. Like climb the S curve up to its full monetization. Is that 50% of the world's asset value? Maybe that's the end state. Maybe that's on the high end in my book. Maybe it's 20%. It's not 0.2%, which is what we're still at currently.